Welcome to Ask the Compound. I'm your host, Ben Carlson. The Roth IRA was created in 1997, named after a senator named William Roth. Wonderful innovation for retirement investors, right? So should you try to convert all your retirement accounts to Roth dollars? Could you essentially live tax-free in retirement? We answer those questions and more today. Stick around. Welcome back. This is Ask the Compound, where we answer all of your questions. We are live, as always. Welcome to everyone in the chat, YouTube, Twitter. You are free to fire those questions away. We answered a bunch of them last week. Bring it. Email here is askthecompoundshow@gmail.com. And today's show, we'll be answering questions about what if the stock market stops going up over the long run? Should you have all your retirement assets in Roth dollars? We'll bring in Mr. Roth himself to answer that. What's the best way to make a career shift into finance? Let's say you just had a baby. What's the best way to save for their future? And finally, what are some considerations if you're moving from a tax with no income tax, a lot of taxes, from Florida to North Carolina? Can you arbitrage that situation? All right.
Also, email us, of course, but also Ben's pulling a lot of questions from YouTube and Twitter these days. So.
As always. Dave said, must be summer based on my shirt. Yes, it's Hawaiian shirt day. I am dressed as Magnum PI today. I didn't wear my Tigers hat, but I'm close.
Nice.
Today's show is sponsored by our friends at Public. Invest in more at Public. Almost everything. Stocks, bonds, treasuries, options, crypto, ETFs. They have a bond account. They have a high-yield cash account. They have a treasury account. You can create your own investment plan. They have IRAs there. Depending on how much money you transfer in with your IRA, they will give you a bonus of up to $10,000. They will also match up to 1% of the amount you put into the IRA. Pretty good deal. Discover why NerdWallet gave Public 5 stars for its ease of use and investment selection. This is a website that was actually created recently, not like 30 years ago like most of them from traditional finance firms. Leave your clunky, outdated platform behind. Check out Public. Go to public.com/ATC to learn more. That's public.com/ATC. Paid for by Public Investing. Full disclosures in the podcast description. Duncan, last week you bragged to me on Slack and you said, listen, I know you give me a lot of crap over the years about Oatly, but check it out. It's flying this year. It's like quadrupled off the bottom, something like that.
I don't know if it's quite done that, but yeah, it's up a lot. John hit us with the 1 month. Look at that.
Oh, 1 month. Okay.
That's a 1 month chart. It's up, I think, around 25% over the last month. So
okay.
Yeah.
So you're feeling pretty good about yourself.
Yeah, I mean, they did a reverse split, which never feels great a while back, but yeah.
Not a great sign. So how long have you actually held this stock for?
From the first day of trading.
So you wanted, okay. Oh, there's the IPO chart. Okay.
Damn it, John.
All right. Yeah, you can. If you squint hard enough, you can kind of see that 25% increase in the last month. But
oh my god,
you averaged the whole way down, right?
I've been buying it like clockwork the whole time. So it's a little. I mean, I'm still down.
Yeah, just wait till it breaks even. It'll happen anytime. You never know.
There you go.
All right, let's do a question.
Okay, up first we got one from Sam from Twitter. 100 years is just a heartbeat in the context of human history. What are the chances that capital becomes so abundant and technological process so rapid that the stock market could decline and never recover? I never hear mainstream keep buying advisors even consider this possibility. I don't quite understand this one. Why would the market, I'm curious to hear what you have to say on this. Why would the market not recover because of those factors?
All right, I'm guessing it's a Star Trek-like situation. I never watched Star Trek personally, but I gather that the genesis of Star Trek was technology made things so abundant, and everyone had everything they could possibly want because they put whatever the machine was, they pushed it and they gave it to them. So then they could just explore galaxies, and I guess that's the case. I've had plenty of people ask me over the years, what if the stock market has a Japan-like situation? So this is a new one, but I've heard this question a lot. Like, what if the stock market doesn't go up over the long run? Yeah, I don't know why an abundant technology world would cause this to happen, because I don't really see corporations willingly causing their businesses to self-destruct, but who knows? And I can't remember the piece that I wrote, but it was some long-term market data that I usually use. So I get variations like this all the time. But I have plenty of thoughts here, but let's do a history lesson first. And I'll use the following example at a lot of my public speaking gigs for financial advisors. So Compound audience is in for a treat today. This is free on the house, guys. So stocks for the long run as a concept is still relatively new, right? For the simple fact that no one really knew what the long-term returns were in the stock market before like the 1960s era. So investors before then mostly cared about dividends, which were just a lot higher back then, and they kind of just bought and held stocks. They didn't really know what the historical returns were. So then this guy named Louis Engel, who was a VP at Morgan Stanley at the time, or Merrill Lynch, sorry, I get those confused. They tasked him with figuring out what are the actual returns so we can bring these to our brokers at Merrill, and then they have ammo to talk to clients and prospects because they were trying to get people to sign up for the stock market because not that many people were involved in the stock market. It was like 4 to 5% of households were invested in the stock market by the 1950s. It wasn't that many people. So Engel contacted the Chicago Graduate School of Business, and they said they performed this historical study if Merrill Lynch would just pay for it. So in the early 60s, this group of professors took this historical data set of all New York Stock Exchange stocks going back to 1926. So they looked from 1926 all the way through 1959. It took them 4 years to complete this, which is kind of insane. Today, it's a snap of a finger, right? And this is now known as the Center for Research and Security Prices, CRSP, right? This is like the gold standard in data. So for the first time, they basically provided the long-run average in the stock market. And once and for all, these brokers finally had something like some ammunition, and the returns were way better than anyone thought. So the Great Depression saw stocks fall 86%, right, Duncan, from 1929 to 1932.
Rough.
Despite that gargantuan crash, what do you think the average annual return was from 1926 to 1959? What's your guess?
7%.
All right, throw the chart up here, John. 10.3%. I looked at this, the average annual return before and after they knew what the returns were. So from 1926 to 1959, the average annual return was 10.3%. From 1960 to 2025, the annual return has been 10.4%. It's kind of interesting. The knowledge didn't really change all that much. And again, because of the Great Depression, no one thought, stocks for the long run, because they got decimated. But it was still much better. So we have about 100 good years of stock market data, but we've only really known about it for 65 years. And let's be honest, not that many people actually knew even then, right? It was much fewer, and so the knowledge is just much greater these days. So would you feel much more confident about the stock market and those relationships if we had 1,000 years of data or 10,000 years of data? Of course. Like then you could say, listen, we've proven this out. N equals 1,000 versus N equals like 1 or 2 for a lot of these things that have happened. But even if we had a much longer history, you have the same exact level of uncertainty about the future, right? Even if the stock market was around for 10,000 years, we could still have the alien attack that causes something to go bad. Although I always say, if we had an alien attack, the infrastructure spending would be amazing. We'd probably have a boom. Fed would cut rates.
Yeah, I was about to ask who that would be bullish for.
Oh, yeah. For infrastructure, I mean, I think the stock market would actually handle an alien attack. Not bad. I mean, anyone who got taken out by the lasers and pulled up in the spaceship.
Yeah, buy the lasers.
That's more stocks for us, though.
You got to buy the lasers.
Yeah. Yeah, not the picks and shovels, the lasers, and yeah. So, I mean, no one knows for sure if history is a useful guide, but there's the old saying that I would rather be approximately right than precisely wrong. So my baseline assumption, again, is the world's biggest corporations aren't going to willingly put themselves out of business. It's kind of like this worry that everyone is going to index fund, right? And everyone's going to be an index investor, then what? My guess is the active portfolio managers, the hedge funds, the private equity investors, they're going to still keep trying to earn and charge the high fees that they do because people like money. So I'm guessing not everyone is going to index. And I don't know, if the thing that I always tell people is if the stock market stops going up over the long run, you're going to have a lot bigger worries than your stock portfolio because it's not going to matter what your investments are, right? What does it matter how you're invested if the stock market stops going up? Then we have way bigger problems to worry about. What's the alternative? Bury your money in the backyard? I always say that the only way to ensure yourself to fail as an investor is if you avoid investing over the long term at all. So I get kind of thinking through these hypotheticals in a doomer way or whatever. It's kind of fun. But I mean, my stance is like the only way you can guarantee the lack of success is just, okay, I'm not going to invest. Is that what you want to do?
So you're saying you got to be in the game. You can't be on the sidelines.
Exactly. And if the alien attack happens, we have Will Smith. He's still here. He still got it. We saw what he did to Chris Rock. He beat up the alien just like Chris Rock, right?
Oh, my God.
All right, let's do another question.
Fair point. Maybe we can throw Basent in there, too, Okay, up next, we got a question from Jeff. I'm curious to hear Mr. Roth IRA Bill Sweet's take on the family in the Wall Street Journal article that went full Roth. Having $2 million in tax-free retirement accounts seems like a no-brainer on the surface. But should that be the goal? What are the downsides to going full Roth on all of your retirement assets?
So I recall reading this article when it came out, and I immediately thought of Bill Sweet. So let's bring him in here.
Get in here, Bill.
Yeah, it's a great read. In fact, my two visuals, can we pull up the first visual here, Dan, John? Yeah, I mean, Roth forever, right, Ben? This is a missed opportunity on my side to rep it hard with Roth King for life.
You should have added a fifth knuckle.
Yeah.
So you could spell out ever.
I mean, I'm just
because I'm sure you did this on AI, and AI is not very good with the fingers yet, so you could have snuck another one in there and no one would have known.
Yeah. No, but it's a great read. But to take it seriously, I mean, Ben, just Duncan, like if you could have $1 million in an IRA account at 65, would you rather have that be all Roth or all traditional?
Well, I guess Roth, right?
Hang on, let me read from the article real quick, because people who didn't read it. So the family is the Rosses, and it says the all Roth strategy is about the tax rates. The Rosses, yeah. That tax rates will be the same or higher when they take money out of the account. So I think they're in their 50s. Paul thinks because of the U.S. government's deficit spending, tax rates are probably only have one way to go up for the long term, and that is up. Roths are a great hedge for that. So it says they have $2 million in their retirement accounts. Spending it down won't require $1 in taxes. They have reached the highest level among the growing number of savers who favor Roth individual retirement accounts and 401ks. Now, my only pushback here is for my entire career, I have heard taxes have nowhere to go but up. And guess what they've done? Only gone down.
Yeah.
Right? And I know you've said this over time. Like, taxes, really, honestly, we have no other choice but to raise taxes. And taxes just keep falling. So I that's my only caveat. But is there... Can you poke, because you're obviously a big Roth guy.
Yeah.
Can you poke, you have a Roth tattoo on your back as big as Ben Affleck's dragon.
It's true.
Is there any downside to this in terms of just lack of flexibility? Do you think, no, even if you lack the tax diversification or whatever it is, the fact that you are free and clear and the planning is easier, if you can do this, and I'm guessing, I can't remember the whole article, did they just converted everything or paying the taxes now? Like, is that the downside, that you're giving up flexibility in the present for flexibility in the future?
I think that's it. I mean, the headline answer is you would have, like, if you were to choose a $1 million Roth, $1 million traditional, that would be a $1.5 million account if it was traditional, right? Because all the tax savings you'd accumulate along the way. The other big one is in distribution, Ben. A married filing joint taxpayer gets a $30,000 standard deduction, and they're only paying 12% up to the first $120,000 or so. And so if you think about like where your median earner is, they're probably the tax rates on the marginal side, probably 30, 45%, somewhere in that territory. And so it's this compounding effect of the fact, okay, your taxes are in the past. That's great. That's where I want to be, certainly. I think that's the choice. But you are giving up something, and what you're giving up is a higher net worth, right? Maybe not pre-tax, maybe after tax, but that to me is the big downside.
They're pulling forward and they're converting those dollars and they're paying them now, so they don't have to pay in the future. So you could realistically say they're trading a vacation to Hawaii now for a vacation to Hawaii in the future, right?
Correct. Yeah. It's the taxes you would have saved along the way. And it's actually a long-time Ask the Compound listener and participant, Dave Airy. He asked in the chat, what would be your ideal balance of Roth brokerage account and traditional? My answer, just because you can't predict the future, a third. I think that's a reasonable way to play it. All Roth seems to be insane. All traditional also seems to be insane. Nick Majouli's thing of let's just forego the 401k outside of the match entirely. That also seems
he's
extreme.
a total taxable guy, right?
Yeah. I
totally.
was about to say he was just going on and on about using your brokerage account.
Yeah. But the reality is there probably isn't a right answer. Like, the future is not just unknown, it's unknowable. Ben, you brought up a key point before. I have been predicting that tax rates are going to go up, and I've been wrong since the ACA in 2012. Right? I've been 13 years of wrong, and it looks like, based on this big, beautiful bill that's working its way through the Senate right now, tax rates are probably going to go down again, right? No tax on overtime, no tax on tips. So ultimately, we don't know. I think diversification makes a lot of sense, and that would be the downside. You are giving up something by going full Roth.
But the one thing is that there is a lot of tax planning, as you know, that goes on in a financial plan for retirement. So I think the ease of use is maybe one of those things where, especially if you're a DIY person, it just makes your life 10 times easier to not have to plan any of this stuff out and make the calculations. And I think that's part of it. Is just
brain
it
damage.
Makes your life way easier.
How much brain damage you want to have. And that's why I think if you just take my thesis, a third, the question is not, do you want to have a large Roth balance? Yes, I do. The question is, when do you want to, in my career, when my earnings are the lowest relative to where they're going to be in my 40s, 50s, 60s, that's the time to super fund. And that's why I don't mind early on in a career, fund that Roth and fund it hard.
What about passing it on to heirs? So let's say you're not going to spend it all, because we know from experience most of these people don't spend all their money in retirement. What is the difference there? Is that better for the heirs?
Yeah, to quote famous philosopher Chuck Palahniuk of Fight Club fame, on a long enough timeline, Roth IRA will always beat anything else. But in a long enough timeline, gentlemen, we'll all be dead. Ben, you bring up the interesting point. You now have 10 years, basically, after your passing, where your heirs have to take a distribution from a Roth or a traditional asset, unless it's your spouse, unless it's your younger brother or sister or something like that. Therefore, there is a timeline, right? And so I'm 45 right now. I hope to make it to 90. That's where Grandpa Sweet made it. So I can see, like, I've got like 55 years of compounding wealth before I pass it on to my kids, and that's about the limit. And I'm right at the cusp where I'd recommend shifting over to more traditional balance.
Bill, you're literally at midlife. Literally.
Yeah, compared to Ralph Sweet, who passed, unfortunately, in 2016. Lived a good life, but yeah, I'm halfway there. Had a good ride. I hope to be with you guys for the next 4 decades.
Time to buy that convertible. All
I'm
right.
trying to picture a 90-year-old Bill.
Wise beyond his years, let me put it that way.
All right.
There was no Roth in 1955, I can say that. So, yeah, we're living the dream.
It's still relatively new, you know?
Yeah, 30 years, that's it. Yeah.
All right, let's do another one.
All right, up next, we got a question from Dylan. I'm a 27-year-old military veteran. I currently make $118,000 a year as a defense contractor. Because of the unpredictability of DoD contracting, I've always worried about my job security and have tried to put myself in a position to change my line of work if need be. Over the last 3 years, I've taken advantage of my GI Bill and have about a year left. I'm majoring in business management and have developed a lot of interest in finance and wealth management. What career advice can you give me as someone in your line of work? How can I position myself to enter the world of finance? Are there certifications or courses that I can take to develop a valuable skill set?
All right, I just had, and thank you for your service. We get all of these veteran questions, which is great. I always appreciate that. And I always say that the fact that these people are thinking so far ahead, especially in their 20s, is great.
I think we have a big enough military audience. I think we should do like a show on a base. I think
we'll do an army tour.
I would love that, guys. That'd be awesome.
That'd be cool.
Yeah, go to West Point. That'd be great.
That'd be fun. I just had a conversation with someone this morning who's in a similar predicament. And now they're not a veteran, but they're looking outside of finance, looking to break in. And I have a lot of these conversations. And I have plenty of thoughts here, but I want to hear Bill first because he's the living embodiment of what Dylan is trying to achieve here. Bill, you went into like computer science first.
I was a computer engineer, yeah.
Rensselaer and then made the transition to finance. So what advice would you have for Dylan here?
Yeah, I think it's relatively easy from the respect that it's simple, but it's not easy to do, right? Simple advice, but it's not. It's actually quite difficult to execute. And I was relatively frustrated, gentlemen, when I went through the CFP course for the credentialing thing. Credentials are one thing. I think that basically gets your foot in the door. It's a great thing to have. I think it
proves that you care, right?
Correct. It's a bar to entry. However, almost zero practical knowledge. And again, I don't mean to demean at all the CFP coursework, but it was very academic. It taught me very little about the actual work of financial planning and working with people.
Right. But if you are outside looking in and you want to prove to an employer, I care about this stuff, I'll put in the time and effort, then I think the credential helps.
It gets you in the door, and particularly the veteran thing, do not be afraid to use that, because I used to say when I was making my pitch, hey, I may not have the credential, I may not have the experience, but I have a master's degree in getting stuff done. And that is something that any employer would value. So Dylan, I think that's it.
Making decisions under stressful,
kicking ass and taking names
and breaking down doors. Yeah,
but making decisions under stress. I agree. If you see that on someone's resume, I think you totally play up to that. I have a degree in acting cool under certain situations, and I think it's a big positive.
Yeah, and beating down hippies that are blowing up cars in Los Angeles. Yeah, I've got a master's degree there. But the hard thing to do is getting that experience. So I know this is nearly impossible with a full-time job, but like pursuing some sort of internship, maybe a summer program, something like that. I know how difficult that is. I'm not taking that lightly. But even if it's like demoing some financial planning software, right? Some practical application of how to do it. To me, that's the way to at least add something of that nature to your resume. It's not academic. It was something relatively practical. But that's the type of thing to do. But ultimately, I think it's you're going to be looking for an entry-level position, probably coming out of the military, and you're going to have to plan on working your way up, right? Because that's ultimately what needs to happen, making that transition. It's not easy.
What I always tell young people is just read as much as you can and become a sponge. I remember one of the very first job interviews I had, the guy asked me, what are some of your favorite investment books? And I had just been reading a bunch of them, and I gave him, I can't remember what exactly I said, but he said, that's a really good answer, because a lot of times I'll ask people that, and they've never read anything, or they don't know any. And I think these days it's easier than ever. So you read all the blogs, you read all the newsletters, you listen to all the podcasts, you read all the classic investment books. I think finding a niche is helpful, and maybe for you, that's helping military members or veterans with their financial affairs as a start.
Ben, you hit it. You hit it on the nail. Nobody likes doing income taxes, guys. Like the industry is falling apart. So yeah, that was a place, Ben, exactly to your point, where I felt I could add some value. I had some software training. I took a look at what CPAs are doing. It was moving into a software base, right? And that's something that I was actually good at, a way to leverage a skill that I had.
And the other thing I think is just finding a mentor. So learning from people who came before you, I think, is a wonderful way to get ahead. One more question from the chat. They asked, nearly everyone will have a lower tax rate in their 50s and 60s. No mortgages, no kids. Isn't that a big argument against a Roth? Fair point?
Because again, your tax rate when you're working is almost certainly going to be higher than it is in distribution phase and retirement, unless you're sitting on a very large pension. That is a great argument.
Okay, fair enough. All right, let's do another one.
Okay, up next we got one from Alan. I was looking back through the archives for the episode where Ben talked about alternatives to 529 savings plans. I couldn't remember if it was an Ask the Compound episode or a Talk Your Book episode on animal spirits, so I figured I'd go straight to the source. We had our little one arrive 7 weeks early recently. Congratulations. She and Mom are healthy and doing great, which means my focus can shift to the task I thought I had until July to figure out. So, Ben, what sort of savings options have you used for your kids, and why would you recommend against a 529 savings plan?
All right, congrats on the new child. 7 weeks is very early, as far as I know.
Yeah, we're still in the not sleeping at that phase.
Also, just for anyone that doesn't know, just briefly explain what a 529 is.
Sure. We actually get a lot of questions from new parents, and a lot of them are like this. And I like the fact that people are thinking ahead. I started a 529 plan for each of my 3 kids immediately after they were born. I know you can do it before kids are even born, then change the beneficiary or whatever. I've made monthly contributions to them ever since. I think we actually had a guest on Animal Spirits who made the case against 529 plans. I'm not going to hear to name any names, Tony Stick. But I don't think I've ever made the case against a 529 plan. That's just a college savings plan. And Bill, correct me if I'm wrong, but they've changed the rules enough that a 529 plan is actually even more beneficial now. Because you can, what's the conversion to a Roth if you don't use it all or something?
Yeah, 100%. Ben, I was going to highlight 4 big benefits. Can we pull up a slide from Q3 real quick? So to me, it's tax-free compounding along the way. You get tax-free distributions in retirement. A 529 is a Roth, except it's only for college. State tax deductions if your state offers it. And then ultimately, Ben, you just mentioned it, new for 2024, last year, we can now convert 529 assets to Roth, stepping in for the Roth IRA contributions. It's basically a way to start funding a Roth IRA at birth, right? At 7 weeks old, you could begin a Roth IRA that your child's not going to touch for 60 years. That's a pretty powerful thing. If you don't need that money for college.
So my oldest daughter,
I don't see a lot of downsides there. This would be my go-to move unless there's something crazy going on.
So my oldest daughter is the teacher's pet one at school, and she gets really good grades. She gets a full ride to Michigan someday. All right, I don't have to pay for any of her college. I can convert that 529 for her into a Roth, and then it's in her name or my name?
It's in her name up to $35,000, a lifetime rollover, right? So there are limits. It's not totally perfect. It's not the full balance. But in that case, Ben, I mean, A, you won the game, so let's start there. Then secondly, you happen to have 2 other kids I know. It'd be a great idea to reallocate those assets elsewhere or carry them forward to a grandchild, right? There's a lot you can do with a 529 now that you couldn't even 2 years ago.
Yes, and not to sell my other kids short. Hopefully they get scholarships too.
Exactly.
In sports.
Exactly.
But is there anything beyond, he's asking here, Alan, and the question is asking, any other sort of options you'd recommend? My whole thing is, I like the idea of thinking ahead and saving for your children, but make sure your own finances are in order first, right? Put the oxygen mask on yourself first, then worry about the kids. So I would make sure that you're maxing out your 401k and putting some money into a taxable account in your IRA or whatever before you worry about putting extra dollars aside for the kid. They've got plenty of time to figure it out. Worry about yourself first, and you don't want to have to be on their budget someday because you didn't save enough.
True, but my general answer would be no. I think the 529 is the right wing. Can we pull up my last chart here? I want to show you guys the single best 529 distribution I have seen in my career. This was an individual going to a large private school that took an $84,000 distribution in 2024, took a look at the basis and take a look at the earnings. Would you like the market to pay for 2/3 of your child's college? If so, a 529 is the thing for you.
Oh, so the cost basis is in the bottom. How much they made is in the middle there.
You got it. $51,000 of earnings. 2/3 of this year's tuition for tax year 2024 was paid for by the market, and it came out completely income tax free. This is a $20,000 tax savings. I don't
And
think
that's
you can
someone
get
who
that in any
obviously
type of
started
account.
saving early, right?
Correct. Yeah, mid 2000s, and this individual is 18 years old, the child. So, yeah, but that's
Not
what's
bad.
possible with the 529. And I don't see this in other types of accounts, guys.
Okay, I've been asked this before too in the chat. Is there any advantage for a custodial account? So that's a brokerage account that's in the kid's name, but really under you, I guess.
Yeah, pros and cons. The biggest thing you get is you do get some tax benefits. The child gets a $1,000 standard deduction, basically, and then the next $1,000, so up to $2,200, is taxed at the child's rate, which is usually zero, right? And so income, dividends, stuff like that accumulates along the way in a UTMA or UGMA account, that is usually tax-free. The problem, Ben, there's two problems. One is that anything that's above that are taxable, fully taxable, right? You don't get any tax break. The second problem is when that child turns 18 or 19, depending on the state, that is the child's asset. You no longer have any control over what happens with that money. If the kid wants to go to Vegas, spend it all on hookers and blow south of the border, you have no say in it.
All right, Dave made a great point here. Did this person where you showed the tax return, they really paid $84,000 in 1 year for college? Where were they going?
Hey, I don't know if you guys are keeping an eye on things, but yeah, that is not
Jeez.
inexpensive. Yeah, that's about market rate for a private school.
Yeah,
You know?
when I was teaching at American University, it's been what, like 7-8 years ago. I think it was 55,000 a year.
Yeah,
I will
welcome to
slowly
Compound
be hypnotizing my children into going to state school, please. State
It's not
public
a bad idea.
university.
Yeah.
now. Yeah, not a bad idea. But no, be prepared because those numbers are going to keep escalating.
Also, someone is asking in the chat, can you trade a 529 account?
What do you mean trade it? Like buy and sell?
Like you can
Totally.
hold
Kevin
anything.
Durant and 2 first-round picks.
Yeah, exactly. And move them
Like
for a
it's-
fantasy asset.
No, can you trade stocks in it, or is it limited to certain things like a 401k? You know,
It depends on the state, Duncan, but I've never seen a 529 at a state level that allows anything outside of low-cost index mutual funds or maybe some active managed American funds is about as crazy as you can get. But
This
I
will be
think
a-
the answer is no.
This will be a shock to a lot of people here, but I actually have all of my children's money in a target date fund in their 529. I know it's pretty shocking, but
It's
it's
the way
true.
to go. It's the way to go.
All right, we got one more question.
all right, last but not least, we got a question from Greer. I think this might be right up Bill Sweet's alley. I'm currently a resident of Florida, which means no state income tax, and I want to convert a chunk of my traditional IRA to Roth. If I complete this conversion while still living in Florida before moving to North Carolina, which does have income tax, will that income be entirely free of state tax? Or is there some sort of tax rule where I'll have to pay income taxes on this conversion? I'm converting because my wife is going to stop working for a few years until our kids are old enough for school, so we should be in a lower tax bracket.
All right, I feel like the tax authorities would have figured this loophole out, but Bill, I can't imagine there's an arbitrage opportunity here, but you tell me. You're moving from a state that pays no income taxes to a state that does pay income taxes. I got to imagine that there's no loophole here.
I did the math on this one, guys. It's just I want you to bear with me. State income tax in Florida this year is 4.5%. So that means per $10,000 you pay $450 for a conversion. State income tax in Florida on individuals is zero. I think I'll have to check, but I think zero is better. So the answer would be if you're moving from Florida to North Carolina next year, I would go ahead and accelerate a Roth conversion rather than wait. It'll save you 4.5%.
But what about the year when you're moving? Like, does it matter if you live in Florida for longer than you live in North Carolina, or is there a cutoff somehow?
I'm so glad you asked this. Different states treat it differently, and you have to look at both the receiving and the sending state. So we don't have to worry about
Like,
Florida.
could I move to Florida for a month and then move away?
I mean, you could, but it wouldn't help you. Yeah, 184-day rule for those of us in New York and Connecticut and other Northeast states. But no, North Carolina follows based on North Carolina sources income, and so I guess you could make the argument if you move mid-year that my IRA, when I converted this back in May and then I moved in July, that was a Florida conversion. I'm not sure it would work, right? So some states say, hey, listen, sorry, you're part-year resident. It's based on pro rata, right? If you spend 180 days in Carolina, you spend 180 days in Florida, half of that should be taxable. Other states apply all or none. North Carolina, so the best of my knowledge is North Carolina sources. So I think you probably would win that argument. The best thing to do, though, is wait for that move to next year if you're considering this, and don't mix up the states. I think that's a really just.
So this
good
is
rule of
probably a CPA question then. This could be kind of convoluted and confusing.
Also, Michael in the chat is asking, what if you have dual residency or dual citizenship? Oh, did we lose Bill?
Nope, I'm back. Yeah, domicile is a big deal. I didn't hear the question, though, so I'll just pretend
I was
did.
saying,
Yeah.
Michael in the chat is asking, what if you have dual residency or dual citizenship?
Yeah, so dual residency is not really a thing. It's domicile is the rule that matters. And very generally, if that's the case, both states would
Yeah, because this is the kind of
dominant.
thing where the hedge fund managers have to live in a certain state for a certain amount of days, right? And it's really convoluted, but they actually do track, especially if you live in New York or California, I guess.
Very typically, yeah, your home state will give you a credit for taxes paid in another state. So it just gets super complex in a big gobbledygook soup,
All
unfortunately.
right, I have one more question for you, Bill. Is it really more advantageous to live in states like Florida or Texas from a tax perspective because they have no income taxes, or do you just end up paying higher property taxes or something else, and does it all end up wash in the end? All right, Bill's having technical difficulties
I think we
today.
lost Bill.
I am. I'm in and out. But for income tax purposes, I would say yes. But the states make their money, right? And so
Wait, they
you
have to
pay
make it
for-
somewhere.
Exactly. So you pay for it in vehicle registrations. You pay for it in ad valorem taxes. You pay for it in property taxes. Very generally, it works really well if your income is high, but that's not the only tax that you pay.
Bill, do you have
Exactly.
Verizon internet?
I do not. No,
Okay.
I switched to fiber.
Dan's
and,
having issues with Verizon today. So, yeah.
Great.
Fiber does sound great until you use it and you realize it's just the same as the other stuff.
Yeah, no, this is the first time. I'm
that's
afraid
not
it's going to
true.
get me kicked off the show.
Oh, come on, Duncan, it is.
Dude,
My fiber
we're-
always acts
We're
up on
uploading
me.
like 20 gigs of files a day. Fiber makes a massive difference.
Yeah.
Okay.
I'm long fiber.
Starlink for the world. That's what
I
we
remember
own.
the days in the 1990s when I used to have to do dial-up, and then if someone called, it would break it up while I'm trying to download songs on Napster, and I have to start all over again. So I'd have to tell my sister to, hey, stop having your friends call. I'm downloading songs here.
I still owe my dad $380 because I was dialing to Poughkeepsie into the modem. Didn't realize that was long distance in 1994. $2 a
Long
minute.
distance.
All
Yeah,
right,
it
Bill,
hurt.
I hope that you are still dollar cost averaging back into the market. Yes?
I went full back. I went full back at the end of May, I think.
Yeah, he
End of
snip
April.
snapped.
Yeah.
Oh, good.
No,
I thought you were dollar cost. All right.
No,
good
yeah,
for you.
Alex Palumbo. He shamed me. He shamed me back into the market. Made a man out of me.
Good. No one in the chat likes Verizon. Everyone, not great. Remember, email us, askthecompoundshow@gmail.com with a question. Thanks to everyone in the live chat on YouTube and Twitter, as always. Thanks to Duncan and the entire production team for keeping the show up and running. No thanks to Bill's internet provider today.
Yeah.
Thanks to you, the listener, for tuning in and sending such thought-provoking questions every week. We appreciate it. Subscribe, rate, review, all that good stuff. See you
Over
next week.
2,100 people watching live right now.
All right.
Great.
Thanks, everyone.
Thanks.
I'll
See
be
you
back.
around.